Hello again, traders. Doing Shabbat here from DRFX, Swing Trading Mentoring. Gonna be taking a look at the trade that was made on the Canadian and Japanese yen, which provided us with a strong trading gain of 76 pips within a very short period of time, which for me on my live account represented a rate of return from this trade of 3.68%. So I'm gonna be taking a look at the main technical elements that supported this trade on the daily and 4-hour charts, to show you once again the main advantages of using Japanese candlestick signals on the daily and the 4-hour charts to accurately forecast market direction and to take advantage of strong trading gains, capture strong trading gains that can provide us with a level of consistency and profitability over the long term. Now, this trade was an example of the first type of setups that we target using Japanese candlestick formations. From the trading manual, you will see here that what we do is to, instead of waiting until the consolidation has been completed and then trading between resistance and support, we identify the early sets of bearish and bullish waves that indicate that the market is going to be forming consolidation. So once we spot that these are the types of waves that are being presented that are indicating the formation of consolidation, we can trade these until the consolidation has been finally completed. Of course, the other way, which is the second setup, is when the market has already completed the formation of these setups, and then we continue to trade between the boundaries of resistance and support that would have been finally completed. The third setup is where we trade false breakout reversals, where the market will initially start a breakout at one end of the consolidation and head back inside. And the fourth setup that we trade, of course, is where we trade consolidation breakouts that provide us with sharp and large movements as well. So these are the four setups, and the trade that was done on the Canadian and Japanese yen was an example of how we take advantage of the early signals that indicate the formation of a consolidation setup. Now, together with those four setups, what we do is to trade certain types of candlestick signals that indicate that the market is going to be providing us with an entry signal. So double bottoms, double tops, ABC signals, bullish and bearish engulfing candlestick formations, evening stars and morning stars, and to a lesser extent tweezer bottoms and tweezer tops. These are the main types of entry signals that tell us that we can now start to trade the movement that is taking place within the consolidation or as the market is forming a consolidation setup. Of course, these are the rate of return targets that I have on my personal live account, and these are the targets that I highly recommend that you also have for your personal trading. Of course, I don't recommend trades to be done on a live account. What I teach is to show you how you can achieve these types of returns on a demo account. And then once you've achieved these types of rate of returns, you will then speak to a licensed investment advisor to then determine if live account trading with real funds is suited for you. So my objective is to show you that these are the types of returns that I have for my personal trading on my live account, and that with my methodology and trading signals, you should aim to capture these types of returns on your demo account first of all, before transitioning into live account trading. So with that said, the first target was actually hit back in June, where the methodology provided a rate of return of 16% since it began in February of this year. However, since then, there were a few losses along the way that pushed the return back down to 10.98%. But with recent trading gains like this one on the Canadian and Japanese yen, and in the next few weeks, where I'm going to be targeting larger range of movements that provide us with larger rate of return per trade. In my particular case, this is going to be between 4% to 5% on average per trade. Then it means that in a very short period of time, I should be back above that 40% target, before moving on to the 30% target within a very short period of time. Now, the aggressive methodology that is used is summarized here, where we basically target a trading gain of between 50 and 70 pips within 24 hours using the signals and patterns provided by the daily chart. However, in certain exceptions, certain cases, such as with the Canadian and Japanese yen, where we're trading larger ranges, then the targets are going to be between 70 and 100 pips. And in those cases, the holding period is going to be extended by 24 hours. So with 50 to 70 pips, we're going to be targeting these trading gains within 24 hours And for trading gains of between 70 pips and 100 pips, we're going to be targeting these trading gains over 2 days. So once the market provides us with the market direction, the daily chart provides us with the market direction, entry is going to be taking place on the 4-hour chart. And the stop loss area that we're going to be using is also based on the patterns provided by the 4-hour chart. But in certain circumstances, if the 4-hour chart does not provide us with a strong stop loss or it's too far away, then we will go down to the 1-hour chart and look for a strong stop loss area to protect our trade. Now to the trade itself. Now, as I said, this was an example of a situation in which the market was in the process of completing the formation of a consolidation setup based on the nature of the bullish and bearish waves that have been formed so far. So here you can see that the market had provided these sharp bearish and bullish waves that were of the equal size as the market started to move sideways. So this was a strong indication that the market was going to be completing the formation of a consolidation setup. In this case, it would be a range setup. So what we have here is that the resistance boundary had already been formed with these two resistance points, but only one support point had been formed so far. So what was expected was that the market was going to be U-turning here to provide us with another bullish wave, and in so doing it would need to provide us with a strong bullish signal to indicate the start of this rally. And as you can see here, this is exactly what took place. Market provided us with a strong bullish engulfing candlestick formation that was a very strong indication of the start of this rally, and that we should start to look for trading opportunities to take advantage of this expected movement. Now, this example was actually very similar to the one that I have in the trading manual that shows how we take advantage of the movements that indicate the start of a consolidation. Here we see an example which is exactly what took place on the Canadian Japanese yen, where the market had already formed the resistance boundary and one support point, and was now in the process of forming the second support point to complete the formation of the consolidation. Now on the 4-hour chart, which we'll see in a while, another pattern that was actually supporting the possibility of a rally was a bull crown setup on that time frame. Now from the trading manual, you will see here an example of a bear crown head and shoulders pattern, which is basically the same thing, just in this case we're talking about a bearish reversal, but the same principle would apply with bull crowns in terms of bullish reversals. So essentially what takes place is that the market will have what we call a left tip, where the market forms a setup as a last setup as part of the previous trend, and then it U-turns one last time to break trend lines that would have been formed along the way to indicate the start of a reversal. So that U-turn creates what we call a center tip, and then as it breaks its way below trend lines that have been formed, it then forms another setup, which we will call the right tip, and this will be the first setup as part of the new trend direction. Here you can see the bull crown setup on the Canadian on the 4-hour chart, where the left tip here was formed, which was the last setup as part of the previous trend, this downtrend. We then had the market U-turn and break this downtrend line to create the center tip, and then as it rallied, it then pulled back and then U-turn to create this bullish engulfing candlestick formation that would essentially create the right tip of this crown. And so since this was a typical example of a bull crown setup, then it added support to the likelihood of a rally back towards this resistance target here. So with these strong signals indicating the expected rally, what was done was then to send you guys this email alert, basically informing you and summarizing the trade setup that I identified on this currency pair, and the main technical elements that were supporting and justifying this trade. And of course, this was the specification in terms of the holding period, where since this is a weekly range trade where we're going to be targeting a larger pip target of between 70 and 100 pips, then in that case the holding period was going to be extended to 2 days as opposed to just 1 day for the 50 to 70 pip trading targets. Now, in terms of the setup, on the 4-hour chart, there were actually two areas where we could have actually placed our stop loss to protect the trade. The first one is where we would place the stop loss below the support at the support point of this U-turn that created this bullish engulfing candlestick formation. However, if that is too far away from entry, and if it required too large of a stop loss, then another alternative would be to place a stop loss a little higher, using these trend lines here as protection for the trade. So this area here is normally a strong area to protect the trade until the trading target has been hit. So these would be the two choices that we would have had in terms of our stop loss: below the support point of the candlestick formation, or a little higher using the trend lines as our protection. In my case, I decided to use it to be a little more aggressive and place a stop loss a little higher using the trend line to protect the trade, mainly because I didn't expect the market to pull back by that much. I did expect the market to pull back, but based on the fact that these previous setups did not pull back before they continued the uptrend, it was very unlikely, therefore, that the market would actually pull back all the way down to this area before resuming the trend. So that was one of the reasons why it was possible to place a stop loss a little higher using the trend line as protection. So this was a setup. A temporary pullback was actually expected here, which would have allowed you to enter at a lower price in case this area here in case entry would have still required too large of a stop loss for you, and this would have then given way to the resumption of the uptrend towards our trading target. So the trading target was set at 86.17, just below the resistance boundary. My entry took place at 85.34 in anticipation of a slight pullback to give me a better entry price, and my stop loss was placed at 84.67, just below this outer uptrend line. Now, why is it that I thought that the market was going to be pulling back temporarily before resuming the uptrend? Well, the main reason is that, as you will see on the 1-hour chart, the daily candlestick signal and the 4-hour chart bullish signal actually coincided and was supported by what took place on a 1-hour chart. And what was seen on a 1-hour chart was that the market had given us a sharp bull candle that normally indicates that a trend is going to come to an end. So with this expectation of a pullback, it offers you the possibility of entering the market with a stop loss of between 30 and 60 pips, which is typically what you can expect in terms of entry on the 4-hour chart. So you can be better able, in a better position, to enter at a stop loss that is more suited to your risk management needs and your maximum stop loss requirements for your individual trades. And so this is what is possible when we can anticipate that the market is going to be pulling back. Now here you can see the 1-hour chart where the market had broken above this counter trend line quite aggressively and quite sharply. And normally when we have a situation in which the market provides us with a large candle like this at the end of a sharp movement, it's normally an indication that the market is going to be pulling back temporarily. Again, from the trading manual, using the example of how we anticipate the end of consolidation breakouts, which can also be applied to breakouts from trends. Basically, what happens is that as the market is ending the breakout, you will have a large candle like this that indicates that the market is going to be ending its movement. And if the trend is going to change, it will start at this area here. But if the trend is going to resume, then it will be a temporary pullback before the market resumes this existing trend direction. And as you can see from the trade result, the market did in fact pull back as expected and would have provided several traders with different stop loss possibilities as the market resumed the movement with a strong bullish candle here to take us towards our trading target and provide us with a trading gain of 76 pips. Here we can see the side-by-side comparison of this trade result with my entry setup Entry taking place at 85.34. Stop loss was easily protected at 84.67. And the market pulled back as expected and allowed me to enter at a lower price at 85.34. And would have allowed you to also enter at a lower price if you so desired. And the market eventually resumed the movement bullish and allowed us to exit our trade at this area here. Now the exit actually took place about 5 pips lower than the 86.17 target, because at the end of the 2-day holding period, this was the floating profit 76. So I decided that it was not really worth the effort to actually hold out for that extra 5 pips, and decided to exit the trade at this level. So this was a trade result, as you can see here on the 4-hour chart. You can also see the result here on the daily chart with the market rallying as expected. And you can see it here with the side-by-side comparison as well. Bullish engulfing candlestick formation provided with the expectation of a rally. And the market rallying towards this area here as expected after 2 days. Now in terms of my live account, what you just saw there is the FXCM platform, where I trade these setups on both the FXCM platform, which I use to identify market direction and which I use for my analysis. However, my live trades are actually done on an FX Pro account. Now the reason is that FXCM provides better analysis, better charts, clearer charts, but when it comes to trade execution, my preference for the FX Pro account is that you can actually see the exact percentage values of your risk and your return for each individual trade, so that you can ensure that you're staying within your risk parameters and that you're getting you're getting out of the trade what you want in terms of the specific rate of return. And of course, one of the benefits is that you're actually able to close your trade, close your platform, and you will actually receive a trade alert indicating when the market has actually hit your trading target. So there's no need to actually monitor the trade, because monitoring the trade after you have executed a trade can lead to a lot of bad habits, a lot of self-sabotaging behavior, which, as you can see in a while, which I'll show you in the next slide, can affect your profitability over the long term. Now, as you can see here, this was a trade result on the 4-hour chart on my live account. You can see here that this is in fact my live account here with FX Pro. Name here, Dwayne Shepard. And this was the trade result as seen on the 4-hour chart of this trading platform. So stop loss was placed a little higher at 84.68 on the FX Pro account, whereas with the FXCM demo account, it was actually a little lower at 84.67, but it didn't really make much of a difference because the market did not pull back by that much. So it pulled back, but the inner uptrend line and the outer uptrend lines were still in place to protect the movement, and so this stop loss was not threatened at any point in time. And as you can see on the daily chart as well, the market has completed the formation of the range consolidation setup following this U-turn that allowed us to create this second support point. Now, another element, before I get into why it's important to not monitor the trade, speaking to the fact that we were actually able to accurately identify a trading target and exit at the right area ahead of the pullback. Of course, this is one of the many challenges that we have as traders in being able to exit the market at exactly the right time before the market actually starts to pull back and take away our trading gains. So as you can see here, the exit took place for 76 pip trading gain, just below the 86.17 original trading target. And as you can see here, shortly after the market reaches area, it did in fact pull back. And so if you would have held out for longer, this would have been the pullback that you would have been facing right now. So it shows that the trading target was accurately identified and that we were able to maximize on the number of pips provided by the market within the 2-day holding period before the market started to pull back. Now, one of the reasons why I decided to exit the trade and set the trading target within the resistance boundary and not at the boundary itself has to do with what I discovered to be the near end value when it comes to movements within consolidation. Basically, what happens is that there are times when the market will not actually hit the boundary that we're trading towards and will in fact sometimes reverse and pull back and head back towards the other side of the boundary without actually hitting the boundary. So that is why I normally tend to exit my trades at this area here, because we're never quite too sure whether the market is actually going to be hitting the boundary or whether it's going to be U-turning without hitting the boundary. Now, from the trading manual, I actually specify this in terms of how we identify trading targets when it comes to trades within large consolidation setups, such as the one that we saw that we did on the Canadian Japanese yen. So with large consolidation setups, what we do is to exit the trade at what I call the near end value, which is basically 80% or sometimes 90% of the distance between support and resistance. So most of the trends that take place within consolidation tend to end at the opposing boundary. But there are times that when the market will actually pull back and head towards the other side of the boundary without actually hitting the boundary that we're trading towards. So because we're not able to actually know when the market is going to be doing either of these two options, the safest choice is to actually set our targets to the area just within the boundary, just in case the market pulls back without actually hitting our boundary. So here you can see an example that's in the trading manual as well, where the market had formed this large consolidation setup, and instead of actually hitting the boundary, it actually pulled back without hitting the boundary and headed towards the other side of the boundary back inside of the consolidation. So that is the justification for why on most occasions I will exit my trades just within the boundary when it comes to trading within large consolidation setups like these. So the main points, bullish and bearish waves. This was a typical example of where we can actually identify these types of bullish and bearish waves that lead to the formation of consolidation. And once we're able to spot them, we can take advantage of them and trade them until the consolidation has been finally completed. The important thing, however, is to ensure that we trade these only when the daily chart and the 4-hour charts have provided us with strong and clear signals that justify us trading them and taking advantage of these waves. So once we're able to once the market provides us with these types of entry signals, then we can either trade them for gains of between 50 and 70 pips within 24 hours, or with larger movements and larger consolidation setups, we can trade them for between 70 pips and 100 pips over a 2-day holding period. Support or trend lines can be used for stop loss placement, as you saw there with the 4-hour chart. And this allows you to have a choice in terms of your stop loss placement, depending on your particular risk requirement and the maximum stop loss that you're willing to use per trade. Bull crowns are very strong indications, along with bear crowns, that the market is about to start a trend change. So in this particular case with the Canadian Japanese yen, the bull crown was a very strong supporting pattern that indicated that the bullish reversal, that the bullish movement was likely to take place. Market pullbacks allow for us to enter the market at a lower price and a smaller stop loss. So if you were going to be entering the market as soon as the candle closed, but it required, say, an 80 pip stop loss or 70 pip stop loss, then once you can identify that a possibility exists that the market is going to be pulling back based on a pattern that we're seeing on one of the lower charts, then we can anticipate the pullback and wait for the market to provide us with a better entry and a stop loss that meets your particular needs in terms of your maximum risk per trade. And finally, and very importantly, as I alluded to earlier in the presentation, it is very important that when we're trading the market, that we never monitor our trades as soon as we have entered a particular trade. You don't want to be a trader who is glued to the market, glued to your trading screen, and constantly watching every pip movement, because the reality of the currency market is that as much as we would like the market to head off towards our trading target in a straight line as soon as we've entered the market, that is more the exception rather than the rule in terms of what normally takes place with the currency market. The natural dynamic of the market is to move in waves, in bullish and bearish waves, pulling back temporarily before resuming the movement towards our trading target. So what will happen is that if you constantly stare at the market every now and then, and you see these pullbacks or these sideways movements, you can easily justify exiting the trade or doing something that leads you to self-sabotage your trade. So to avoid that possibility and to avoid that bad habit that over the long run can sabotage your profitability, the best thing to do is to close your trading platform. Have a platform like FX Pro that allows you to receive FX price alerts, so that you can know exactly when the trade has exited, has ended, and you can actually analyze the trade. If you don't have a platform like that, then one of the things that you can do is to basically wait until I provide you with the email alert telling you that the trade has been closed or that we are about to exit the trade at the end of a particular holding period. Now, another advantage of using the 4-hour chart and the daily chart with regards to not having to monitor the charts is that, as you can see here, there are the 4-hour chart and the daily chart have predictable times when their candles will be closed. So within these 4-hour time intervals, you can have a normal life and go about doing whatever you do outside of trading, knowing that you can check the market at particular times for the particular trading signal that you're looking out for. So you don't have to be monitoring the trade every minute, which is what you tend to have to do when it comes to using the lower time frames. So the larger time frames, predictable ending times, you can know and set your schedule. You can set your schedule within the context of these predicted closing times of these candles. Another important thing that is very important when it comes to trading is that you don't want to, not only should you not monitor your charts, but you should not look at any financial news, read any financial news, or look at any correlated currency pairs to the one that you're trading for clues as to whether or not your trading decision was correct. What this will do is will put a lot of doubt in your mind about your accuracy and your decision, which is something that you do not want to do. Assuming that you have a profitable trading strategy that has been proven to work, then anything that is saying something to you that is, in other words, you do not want anything that is unreliable to be giving you doubts about your trading decision, which in most cases is correct. So what you'll find with news reports is that a lot of it is temporary and short-term and volatile and therefore unreliable. So even though you might see the market, you can see the market news indicating, say, a gain in the Japanese yen is taking place or likely to take place, which is going against what we're trading, which is in this case a bullish position in favor of the Canadian dollar. Then that sort of news can actually put some doubt, unnecessary doubt in your mind in terms of your trading decision. But what happens from time to time is that in most cases, that news report is reflecting that temporary pullback that we just saw on the 4-hour chart. And so that was always going to be expected on our part. And so there's nothing new in the news that will allow us to change our decision in terms of what we expect to take place on the currency pair that we're trading. So by following these guidelines and by knowing exactly when the market is going to be closing in terms of the times for the daily chart and the 4-hour chart, we can avoid the unnecessary and bad habit of constantly monitoring the trade, constantly monitoring news that in most cases is volatile, which can affect our long-term profitability. So just to show you an example of what the consequence of that would have been, here we see that we did in fact predict that the market was going to be pulling back. And so this pullback was going to be temporary. But if we had been monitoring the market and looking at the market, and we saw this final bearish candle here, it is a natural human behavior, especially when we're talking about live money, real money, to begin to doubt yourself, especially if you are able to see the actual floating profit and loss that is taking place on your account. So it is natural that many people would actually start to change your stop loss, adjust your stop loss, or perhaps exit the trade altogether. And they would have foregone all of this trading profitability that the market provided as it eventually U-turned and provided us with this trading gain. So to avoid missing out on profitable trades because of these temporary pullbacks, it is best to implement a certain level of discipline and measures so that we are not tempted to actually see the market and make these types of bad decisions that can affect our profitability over the long term. So as I said, it is best if you get a trading platform like FX Pro that allows you to receive trading alerts like this, that tells you when the market has provided us with a trading gain or a loss, which is something that happens from time to time, so that you know exactly when to check the market and when to look at the platform and when to know when is the right time to actually look at the trade. So there's nothing that you can do to affect the trade once it's the right decision. And if it's the right decision, in most cases, the market will pull back and pull back temporarily. But you want to avoid having to monitor the market any at all, and prevent the bad habit of closing trades too early to set in as part of your trading activity. As I said before, also, if you do not have that type of platform that provides you with this email alert, what I also do, which is what I did here with regards to the Canadian Japanese yen, was 10 minutes before the close of the trading day and the end of the 2-day holding period, I sent out this email telling you that that I was about to trade, I was about to exit the trade, and that in some cases, depending on your trading platform and depending on your spread, or depending on what your original target was for this trade, your trade may have been closed already. But in my case, and in the case of other persons, the trade was still open, and so this trade email alert was basically sent out informing you that I was about to exit the trade, and that this was now the time for you to do that as well. So, in summary, this trade was a very typical example of how we go through the market and analyze each currency pair using these 8 steps to ensure that we accurately identify what is taking place on the currency pair that we're looking at. We identify and avoid many of the market traps that the market can set for us from time to time, and focus only on the profitable trading opportunities, and placing our stop loss at the right area, selecting the best areas to protect our trade, identifying the right trading target that will allow us to maximize on the trading gains ahead of reversals. And so once we follow these 8 steps, then it puts us in a much better position to achieve long-term sustainability in the currency market by taking advantage of Japanese candlestick formations on the daily and the 4-hour time frames. So that's it for this trade. A very good trade, a very short trade, an aggressive trade in being able to capture these number of pips in such a very short time, and especially in terms of our rate of return that was captured on my live account of 3.68%. So of course, if you have any questions, you can hit that reply button and email me and let me know. You can also contact me via Twitter, Worldwide876, as well as via my Facebook account at DRFX Trading. So until next time, traders, take care.